Hey guys, welcome back to the channel. In today's video, we're discussing 5 advanced interview questions for financial analysts from my perspective as a corporate controller and a hiring manager. And this is good for someone who has a couple of years of experience as a financial analyst, or someone who's an auditor or an accountant and looking to break into the financial analysis world. This is also going to be useful for someone who's at the beginning of the journey as a financial analyst and looking to see what's to come in the future. What kind of questions will they encounter as they get more advanced in their career? And for those of you who haven't seen my prior videos on financial analyst interview questions and answers, I'm going to leave links to that down in the description below. Go ahead and check it out after you watch this video. But for now, enough with the chit chat, and let's jump into today's topic. All right, so question number 1 on my list, the question goes, if you could choose one financial metric to assess a stock, what would it be? And so basically to this question, there's a couple of different good answers. So basically you have to come up with the answer before the interview, come up with a financial metric that you can stand behind and defend and explain to the hiring manager and just be able to defend it and speak to it. So from my perspective, the 2 financial metrics that I would choose is price to earning ratio and free cash flow. And so basically just be able to explain what this is to the hiring manager. So obviously price to earning is taking the price or the market capitalization, the value of the company, and dividing it by the earnings. And this is a really good way to benchmark companies and compare stocks against each other and figure out whether a stock is overvalued relative to its earnings. Obviously the limitation to that is that if a company is before earnings, so the company is in loss position, haven't made money yet, this will be irrelevant, this won't work, right? But this is one of the most commonly used financial metric to assess a stock. The second one on the list is going to be free cash flow. The definition of free cash flow is in the name. So when you look at it, it's cash flow, meaning cash coming in, and free, obviously that means that the company is free to use the cash flow in whichever way it sees fit, whether to distribute to stockholders or to pay down debt. But this is a way to look at a company and figure out if it's making enough money from its operation to have a free cash flow or free cash on hand to use it in whichever way it chooses. So these are the 2 metrics that I would speak to. Figure out the one that works for you, the one that you can stand behind, and one that is commonly used by financial analysts, and be able to speak to it during the interview. All right, the next question on my list is, why is EBITDA important? And so the first thing that I would do is define to the hiring manager what EBITDA is, and that gives you a good running jump into discussing EBITDA. So first you can explain that EBITDA is earning before interest, tax, depreciation, and amortization. And the importance of EBITDA as a financial metric is that it allows the financial analyst to be laser focused on the operating profit of net income, right? So it removes the non-operating part of net income. And so basically you can then explain that EBITDA removes the effect of certain aspects on the business from the equation. So basically you can break it down. EBITDA is earning before interest. So interest is typically paid on financing, right? You have a loan, you have interest on the loan, so that's financing. So that's removing the financing aspect from the net income. And then tax, so the T stands for tax, removing the tax since tax is not an operating part of the business as well, right? And then you have depreciation and amortization. Well, depreciation typically is depreciation of a capex. So you have a capital expenditure to acquire an asset and you depreciate the asset over time. It's a non-operating part of the business, so you remove that from the equation by looking at EBITDA. And then amortization, typically amortization is an amortization of an intangible. So an intangible is also non-operating part of the business. So you can see these are all the components of the non-operating side of the business. And so by looking at EBITDA, you're laser focused on only the operation of the business, and that allows you to benchmark businesses together against each other and figure out which business is operationally more profitable. So that's the answer to the question on EBITDA. That's the second question on my list. All right, question number 3 on my list is, how can you explain solvency? And this is kind of an easy question, but you just have to learn how to articulate it well in an interview, right? So a solvency is a company's ability to meet its financial obligations, right? So this is the company's ability to meet its current obligations and long-term obligations as well. And the easiest way for you to figure out whether the company is solvent or not is to look at the balance sheet and look at the equity section, because the equity section is basically taking all the assets and subtracting out all the liabilities, and what's left is called equity, right? And equity then is the company's firepower, our ability to meet its current and long-term obligations, right? So equity is one way to figure that out. And then the other way is current ratio. So current ratio is another way to drill down and get more granular, which is looking at the current situation of the company by taking the current assets, subtracting out the current liabilities. So a current ratio equals current assets minus current liabilities, and that gives you an idea of what the company's current assets, whether they're able to meet their imminent or short-term obligations. And so this is the second way to look at it. So it's a really easy question. You just have to rehearse it and prepare for it. And this is basically question number 3. All right, question number 4 on my list. And the question is, what factors to consider before taking out a loan? And obviously here we're talking about a business loan, not a personal loan, because this is a financial analyst interview. And so basically there are a few things that you have to run through before taking out a business loan as a business, right? So the things that you have to consider are going to be doing an analysis of the cost of debt versus equity. So basically there's a cost associated with taking out debt versus taking equity, because the two ways of financing the business are going to be either taking out a loan or issuing equity, right? Issuing stock. So you got to go through an analysis of figuring out which is more cost effective, debt versus equity. So that's the first thing you have to do. The second thing that you got to do is looking at how the funds will be used. And figuring out whether you have a strong business case for it. So basically you have to have a plan of how you're going to use this money, right? So looking at an analysis of how the funds will be used and making sure you have a strong business case. And then the other thing you got to look at is ROI versus interest, because basically you're taking out this loan, you have to make sure that the return on the investment of that loan, so you're going to take out the loan to expand the business, open up new stores or new branches or whatever the case is, you gotta make sure that the return on this activity is going to be higher than the amount of interest that you're going to be paying. If this loan has an interest rate of 20% or 30%, right, then the return has to be higher than that. So you got to make sure that the money you're going to make out of this deal is going to be higher than the interest. So this is the third thing you got to look at. And then the final thing is the payback, because basically you have to have a plan to pay this back, right? So usually a loan would have a term and a schedule to pay it back. You just have to make sure that you're going to have enough money, and that's why you got to have to go through this analysis and making sure that this activity would generate enough return to be able to pay back the loan. So these are the things that you'd have to consider before taking out a business loan, and that is question number 4 on my list. All right, so question number 5 and the final question on my list today is, which financial statement do you monitor whether a company has enough cash to meet its current liability? And so basically you don't have to really overthink it. This is an easy question. To meet current liabilities, you need to have enough current assets on the balance sheet. So the first place to look is the current assets on the balance sheet. But for that, I'm going to give you a bonus tip here in a minute. If you really want to shine in answering a question like that, I'm going to give you a really good tip on that in a second. But the second place to look at is cash flow statement. So looking at the cash flow statement, there is a section on cash from operating activity. And on there, you can see whether the company is bringing in enough cash inflow to meet its current liabilities. So that's the second place you can look. But going back here for a minute to current assets, the bonus tip that I have for you is that you need to ask for supporting detail for current assets, because what goes into current assets is mainly accounts receivable and inventory. And with these things, you need to ask for a supporting detail. So for example, for AR, you look at the aging schedule, and the aging schedule can show you whether the company has a bunch of age AR that maybe will never be collected, but it's sitting there as a balance. So you need to make sure that this AR balance is something that the company is going to collect in the future. If a lot of it is past due, it has lower likelihood of being collected. The second thing is inventory. So if inventory, you need to ask for a supporting schedule of inventory. So basically a company on its inventory balance can have a bunch of obsolete or expired goods that has no value, but still has a balance the company hasn't written off yet, right? So you need to ask for a supporting detail by aging on AR, by expiration date or obsolescence on the inventory side. And that's the answer here to figure out whether a company has enough cash on its balance sheet to meet its current liabilities. And that's all for today. So go ahead and like the video if you haven't done so already, and go ahead and share it with friends and coworkers who you think will benefit from a video like this, and I'll see you in the next video.